Okay, so probably the largest section on the Mac exam and the part that will take up the most points is called budgeting. So budgeting takes up the entire page. It's all of this, and it may look really daunting and confusing and scary at first, but I promise you this is all just a lot of steps, and they're all relatively simple steps, and there's a lot of repetition. And with this, it's hard to make these steps confusing, I should say. Like in a lot of the other math and a lot of the other Mac concepts, it's really easy to tweak them and make them a little harder. I would say with budgeting, they can do the least to this topic. So it should be, even though it seems like a lot and it is the most, it should be relatively straightforward, or at least I'm hoping so. Um, so before we even start, I'm going to kind of get in to explain why we do all of this. So you'll notice that there are a bunch of charts. There's this one called a sales budget, a cash collections budget, production budget, raw materials budget, labor budget. There's overhead budget, cash payments, and then cash flows budget. So these are all just a bunch of different budgets that the company is making. And before we actually go into what they are themselves, I'm going to give you a quick rundown as to why we're making these and why they're in this specific order. So I'm actually just going to text this to the side and make a text box. Let's hope this is okay. That's fine. Oh. So first, we want to start off with our sales budget as a company, because you want to figure out exactly how many units you think you're going to sell each month. And then based off of that, you want to make a cash collection budget. So what we know from these sales is that in the case of these businesses, most likely you're not collecting all of your revenue from sales the month you make the sale. And we'll discuss this further, but oftentimes whenever you sell an item, you actually get part of the revenue in the form of cash in the months following. So in the cash collection budget, you just want to figure out exactly how much cash you're getting each month. And then we get to kind of the expense budgets. So we want to figure out if we're collecting this much cash, we're making this much revenue each month, and we're collecting this much cash each month, how much are we spending each month? So to do that, we first need to find a production budget. So how many items do we need to actually make each month to fulfill these sales? And then based off of the production budget, we're going to figure out a raw materials budget. So I'm just going to say DM budget. So how much do we need to buy in materials for each month? Then we're going to do a labor budget. So how much labor do we need to buy each month? And then overhead budget. So how much overhead are we going to incur each month? So again, these are kind of like the three costs, and they're based off of this production budget. Once we have the costs, then we can write out a cash payment budget. So this is the opposite of the cash collection budget, whereas in cash collection, we're collecting cash. Cash payment, we're paying cash. And in the same way, you don't always pay for your expenses the month you incur them. So let's say you bought direct materials, you may only have to pay for half of it at that month and then the other half the next month. So you're just figuring out exactly how much you owe in cash each month. And then you do all of this so that you can put the cash collection budget and the cash payment budget together to make a statement of cash flows. So how much cash do you have coming in each month and how much cash do you have coming out each month? So therefore, what is the total change in cash each month? So that is why we're doing all of this. So now let's kind of jump in. So our sales budget should be really, really easy. It's literally just just figuring out the revenue for each month. So we're just going to take the estimated price per unit of each month times the estimated quantity we're going to sell in that month to figure out how much we're going to sell in each month. And these are revenues. So that's the sales budget. Simple as that. The second budget is called cash collections budget. So as we discussed, even though you make a sale in a month, it doesn't mean you're going to get all the money or all the cash from that sale in that month. So for October, you sold $60,000 worth of units, but you're not going to get $60,000 in October because a lot of those people that are buying these products from you are going to pay for part of their purchase in the months following October. So we're going to split the cost up, the revenue into two parts. One is just cash, so they're going to give you straight up cash right whenever they buy a unit. And the second is credit. So a credit sale, just like as it sounds as a credit card, is kind of a deferred payment. So they'll pay you in cash a month or two after the sale. So that's called credit. So in these examples, they're going to kind of give you some information here. Let's focus on this right now. They may say you collect 20% of the revenue in cash, and we're going to forget about this for now. And then they're going to say of the 80% credit sales, so the 80% remaining that's not cash, you're going to collect 30% of that 80% 1 month later and 70% of that 80% 2 months later. So just based off of these, let's figure out how much cash you're collecting in each month. So in this case, it'll say make a cash collections budget for October, November, and December. So let's just start with October. You want to list them out at the top, and then you want to list out all the months that you'll collect cash from to the side. So one thing you might know is that we're only doing October, November, December. However, we're going to include August and September here because we're collecting cash up to 2 months after the month of the sale. So we need to start 2 months before October, which is August. So let's forget about these two for now, and let's just start with October. So in October, it says we collect 20% in cash the month of. So in October, we're going to collect that 20% of the $60,000 from October. Now, one thing you may notice is this 90% here. That's because it says in this question, it kind of mentions that in the first month, so when they collect 20% of the cash, they're going to give customers a 10% cash discount. So this is really frequent, these types of problems. It's basically just a way of thanking customers for paying for a part of their product immediately whenever they buy it. So they say, okay, since you're spending 20%, you're giving us 20% of the total revenue in the form of cash. We're going to give you 10% of that cash back. So you're getting 10% of this 20% of this $60,000 back. So therefore, to figure out how to make that into mathematical terms, we just multiply the revenue times 1 minus the percent discount. So 1 minus 0.1 equals 0.9. So again, we're going to take that 20% cash multiplied times the 90% to account for the fact that you're going to lose 10% of that, and multiplied times the 60,000 in revenue for October to figure out exactly how much cash you're getting from October in October. So next, let's stay with October. So to figure out how much of October's revenue you collect the month after, or in other words, in November, you first want to take that 80%, because remember, you take 20% cash, so 80% is remaining. So 80% of that 120 is remaining. But then you also know that you collect only 30% of the credit sales 1 month after. So only 30% of the 80% of the $60,000 in revenue is collected in November. So you just have to take 30% times 80% times 60%. And then to figure out how much cash from October you're collecting in December, you're still going to be left with that 80% credit sales, but this time it says 70% is collected 2 months later. So you're going to take 70% times 80% times that $60,000. So this is how we know how the $60,000 in revenue from October got distributed to each month. And what you're going to want to do is you're going to want to make this list and kind of figure out exactly how much cash from each month is distributed in each month. And then at the end, just add them up. So all of these, all of these, all of these, and add them up at the bottom to find the sum of cash that you receive in October, November, and December. Now, one little trick I'm going to mention with this problem is that if you notice in August and September, so these are obviously in credit sales, which is the 80% of the remaining sale, because you're not collecting them in August and September right now. We're focusing on the months after, October and November. The only thing is, if you check, we didn't actually multiply them times 80% times the 20% or the 80% times the 30%. And the reason is because it says in the problem that August and September sales were credit sales. So August and September credit sales were 50K and 70K. So they already took out this 20% cash, and they already told us that this is the remaining 80% credit sales. So we don't need to account for that. So yeah, so that is how you do a cash collections budget. I would recommend going back into the question that I'll be doing, pull up into it in another tab, and then try working through that cash collections budget. But this next part is the production budget. So the production budget is saying, okay, in October, we plan to sell 15,000 units. And in November, we plan to sell 14,000 units. And in December, we plan to sell 11.9 thousand units. But that's not actually how many we're planning on producing that month. And the reason for that is because of safety stock. So in these examples, it'll oftentimes give us an inventory policy. So in this one, it says, end each month with a finished goods inventory of 10% of the current month's sales. So this is basically saying at the end of October, we want 10% of the October sales in safety stock. So let's just kind of work that through. We have 15,000 units in sales for October. So therefore, the required end inventory, or in other words, the safety stock at the end of October, will need to be 10% of October's sales. So we'll need $1.5 in safety stock at the end of October. So yeah, in total, you may say, okay, that means we don't need to produce 15,000 units, but instead we need to produce 16.5 thousand units for October. But the thing is, you have to remember that because we end each month with safety stock, that means we also begin each month with safety stock. So a good way to think about that is, let's say this is a warehouse in October. Just because this gives students some problems, so I'm going to illustrate it. This is a warehouse in October. Now, let's say you have, let's just do it actually, 1.5 units at the end of the month in October. So this is 1.5. Sorry, that's like a horrible drawing. So right now the month is October, and it's the end of the month. So you have 1.5 thousand units in October at the end of the month in your warehouse. Now, the day passes and it goes from the last day of October and now it's suddenly November. And it's the morning of November. And now you see you still have the same 1.5 units, but it's the beginning of November. So therefore, we know that the end inventory of October became the beginning inventory of November. And the end inventory of November that you'll need will become the beginning inventory of December. So just remember that. And in this case, they would have had to give us the September's sales in order to figure out September's end inventory in order to figure out October's beginning inventory. But anyway, so because we know that you're coming into October with this $1.6 thousand in inventory already, if you need 16.5 thousand units because this is how many you're selling, this is how many you need at the end of the month, but you figure out that you already had 1.6 thousand units, then you could subtract that off of it because you don't need to make it anymore. Therefore, in October, although you're selling 15,000 units, you only need to produce 14.9 thousand units. And that is a really important number. Super, super, super important. Because again, as I said, we're going to use this number, we're going to use this chart and specifically this number to calculate 3 other charts after this. Okay, so really keep that in mind. Because in terms of managerial accounting, again, we don't care really how much we sell. Like, it's great if we sell a lot, but whenever we're looking at the costs in the accounting aspect of all of these, we care about how many we make. So this is why we really care about this number. So the second chart is called the raw materials purchasing budget. So this is just figuring out exactly how many materials we plan on purchasing each month. And it's super, super, super similar to the previous chart and follows a lot of the same processes, but just with a few add-ons. So first, you want to drag down that production, because again, we're going to use that in every other chart from now on. And then based off that, you want to figure out, okay, how much raw materials do you need that month? This is kind of like the new sales units. So this is kind of where we're starting in this chart. So we're just going to take the required production multiplied by how many materials it takes to make each unit. Let's say 3 pounds. Let's say we're making giant candles and we need 3 pounds per candle. Therefore, if we need to make 14.9 thousand candles this month, then we need 44.7 thousand pounds of wax. In this case, it says we want to end each month with a raw materials inventory, so safety stock, of 10% of next month's required sales. So therefore, the end inventory isn't going to be based on the beginning inventory. It isn't going to be based on the raw materials needed of this month, but it's going to be based off the next month. Notice how that's different than the above chart. The above chart says of the current month, so we're going to take that 15K times 10%. This time it says of next month's required, so we're going to take next month's raw materials required times that 10%. It could switch on either one of these. Both of them could be current, both of them could be next. Just be really mindful of that. Anyway, if let's say for November we have 13.9 thousand units we need to produce, so therefore we need 4.17 thousand materials. The end inventory will base off of December's, so that's the end, and the beginning will again be based off of October's end. So it's going to kind of make this zigzag pattern. So if the beginning is this, then we know we only need to purchase 41.4 thousand pounds of wax. And then so the final step will just be to multiply it times the price per pound. As we see here, we're going to take that $70 per pound multiplied by that number of pounds we need to purchase to get whatever number. Now, something to be mindful here that students get confused by often is for the first month, if they tell you that you need an end safety stock based off of next month's required materials, then for that first month, you don't actually need the month before. You don't need September to figure out the beginning inventory. For the above chart, we needed it, but for this one, we don't. And the reason is, if we're looking for the beginning inventory of October, that tells us we need the end inventory of September. However, the end inventory of September is going to be based on the next month's sales, required, which is October's required. So therefore, we can say the end of September will be based off of October, and the end of September will become October's beginning safety stock. Or in other words, October's beginning safety stock is just 10% of October's required. So we don't actually need September. That does mean, however, that we need January to figure out the end inventory required for December. Okay, so again, I would recommend go to the problem, practice making these charts, and see how you do. This next chart is called a labor budget. So it's just asking, okay, we plan on producing this many units, again, not selling, producing. So how much do we need to spend on people to actually make it? So in this example, I'm going to focus on December because I like how it works out in the end, and you'll see why. So in December, we noted that we needed to find 11.7, we need to produce 11.7 thousand units. So first things first, we need to figure out exactly how long it'll take to make each of these units. So it'll tell us how long it takes to make each unit. In this case, 18 minutes per unit. So we want to turn it into an hour format, and you'll see why in a little bit. So if it takes 18 minutes to make each unit, that means it'll take 0.3 hours. Therefore, 0.3 hours times the 11.7 thousand units we need to produce means that we need 3.51 thousand hours to actually make this number of units. So now there's one thing we need to remember too, is that in any real world scenario and in these managerial accounting problems, workers aren't 100% effective. They're not 100% productive. They're going to take spoke breaks, lunch breaks, and sometimes they're just not going to be working diligently. They may kind of doze off or go to use the restroom or kind of just stare at their screen. So we need to account for that because we're still paying them for that time, but we need to account for how much time we have to pay them that they're not actually building these items. So that's called idle time. So to find the amount of idle time we need, we're going to find this ratio. We just need to find the idle time ratio, and that is idle divided by productive. So we need to find the total idle time per the amount of productive time they work. So in this case, like this example, it says 20 minutes divided by 40 minutes. That's telling you that there's 20 minutes of idle time per 40 minutes of productive time, which means the ratio of idle to productive is 50% or 0.5. Now, one common mistake I see students make is that they'll see in this question, it may say 20% of 20 minutes of every hour are idle. So they'll say, okay, cool. So 20 minutes of every hour idle. So that's 20 divided by 60 minutes an hour. But remember, we're not looking for per hour. We're looking for idle divided by productive time. So we can't do 60 minutes. Instead, we have to say, okay, 20 minutes are idle. That means 40 minutes are productive remaining. So be really careful about that. So once you found the idle time ratio of 0.5, you'll just have to multiply the productive time times the idle time, times that idle ratio to find the total amount of idle hours you'll need. Add those two up to figure out the total amount of hours you'll need to produce this. And this is considering all the time your workers are kind of twiddling their thumbs. So on the next part of these problems is just to figure out, okay, if that's how many hours we need to actually spend making these products, how many workers do we need to hire to make them? So they're going to tell you how many hours each worker works per week, per period. In this example, they say 160 hours per person per period, probably a month. Therefore, if we know that we need to spend 5.27 thousand hours making these, and each worker works 160 hours per period, we just need to take that, divide it by 160 hours per person to figure out that we need, okay, 32.9 workers. So one thing to note is this means that to make all of these units, to fulfill all of these hours, you'll need 32 full-time workers plus one part-time worker who's only going to work 90% of the time. So that'll be great. That would be awesome. But in these questions, you're oftentimes given rules. So it may say as a rule, you can only hire full-time workers. Therefore, that 32 full-time workers and one part-time worker bumps up to 33 workers. And another stipulation they may give you is that the workers may work in pairs, or maybe you can only hire workers in pairs. Therefore, even though you only need that 33 full-time workers, you have to hire 34 workers so that they can work in pairs. Now recall again, you only technically need 32.9 people to make these. However, because of these rules, you need to hire 34 people. So once you're done with that, you can figure out the last part of this problem, and that's just to figure out, kind of like the raw materials budget, what is the actual cost that you'll have to incur per month on labor. So all you're gonna have to do is take the amount of people that work per month, multiply times that 160 hours they work, times their pay. In this case, it says $12 per hour plus 10% fringe benefits. That's 13.2. And that'll tell you how much you need to spend per month on labor. So now we're on to our final expense budget, and that is manufacturing overhead budget. Now, you may notice that I don't actually have a chart for this, and that's because these budgets can be listed in so many different ways that I didn't want to give you a chart and confuse you, but I just want you to remember the basic idea behind them. So remember how each of these budgets that we made are based off of production units, not sales. Manufacturing overhead budget is going to be the same exact thing. So they're going to give you a list of activities, most likely. They may give you just one giant overhead and say it's based off of this, but they're probably going to give you activity 1, activity 2, activity 3, and they're going to say each activity is worth, I don't know, so-and-so $100,000. And it's based off of the number of produced units. So you'll just have to take that cash or that driver. Let's say it'll probably say something like it's $2 per activity, and you do each activity per unit. So you'll just take that cost times the driver, so the driver times production in most cases, to figure out exactly how much overhead is allocated based off of each activity. Now, it may not always give it just straightforward, as in like $2 per unit, and you do it based off units produced. It may say $2 per every inspection, and you may only inspect 20% of the units you produce. So you have to take 20% of this unit produced and then times $2 to figure out the overhead or something like that. Again, they can throw you a lot of curves with this, but the main thing to remember is just focus on the units produced to figure out exactly the quantity of your driver, and then figure out what the driver is based on and figure out what the overhead is for each activity and such. So again, I would go and try to do the problem, see if you can figure it out. and we're almost done with this. So the next part is, this isn't actually a budget, it's just something useful to know because they most likely will ask it. If they ask you the product cost per month, then remember, again, product cost or manufacturing cost is DM plus DL plus overhead. So all you're gonna have to do is figure out the direct labor for each month, so the cost per month based off the above chart, figure out the overhead for each month based off the overhead chart, and figure out the direct materials for each month. But there's one trick with this. You have to use used direct materials. You can't actually just go to the direct materials chart and say, oh, we spent 3,108, oh, actually $3,108,000 on materials this month. You can't use that. And the reason is because of this safety stock. Now remember, when we're doing product costs, we're looking at the cost to actually manufacture items or products. Safety stock isn't actually used to make these products each month. It's used in preparation for the future months. So we don't want to include it because it's not actually being used to manufacture a product yet. It will be, but it's not for those months that it's incurred. So what we want to do for direct materials is simply just take the required production multiplied times the price per unit. So just use these units. So not, oh, actually, sorry, required raw materials. So that's here, not required production. Required raw materials for each month based off of the cost of material per unit of material. So in this case, if they ask us for, if we need to find the DM for October, we would take this 44.7 times the $70 per pound to figure out exactly how much we would spend on used direct material for the month of October. Okay, so that's how you'd figure out the product cost per month. Now, so we're kind of on these last two charts. I'm not going to go too in depth for these because they can again switch these up a lot. So the last one is the cash payment policy. It's super similar to this cash collections budget, but except it's just looking at how much you're spending each month instead of how much you're collecting each month. So in this case, again, DM purchases, that's based off of our chart from before. And this does include the total cost that we found before. And then we're going to include the labor wages, which we found from the chart before, and the overhead costs, which we found from the chart before. And you're kind of going to do the same thing for cash collections, except with these costs. So for DM purchases, you're paying 60% in the month with a 1% discount. So that's 60% times 99% times the purchases in that first month, and then 40% the month after. So you're going to do like the same thing except as you did in the cash collections, except with these costs. And once you do that, yeah, and by the way, you want to find your sum at the bottom. And by the way, if you haven't caught that yet, these again are just taken from the three charts we found above. This labor chart, overhead chart, and raw materials chart. That's why we made those charts, is so we could make this cash payment budget. So then finally, once we have our cash payment budget, then we can work on our cash flows. So all this is saying is just, okay, cash collections budget, how much cash do we have coming in? So for October, that was A. November, that was B, blah, blah, blah. And then so we're looking at our cash payments, how much cash do we have going out? For October, that was D. November, that was E. You're just going to subtract that to find the total change in cash. So how much cash are you gaining or losing each month? Now they may also add in, they may tell you that you start off with this much cash. So they may say you start off with $200,000. All you have to put that is like put 200,000 at the top, then say you gain this much cash, you lose this much cash, so you change this much cash, so you get $200 minus whatever the change in cash is to find the net cash at the bottom. They may do that, but yeah. So again, I would go to the practice problems. Now I will say for the practice problems, I'm going to split it up into two videos because there were really no problems with all of this on it all at once. So I'm going to do two problems, one that encompasses all these charts that I like a lot, and one that encompasses the cash collections and the cash payments budget. So there's one more small part to budgeting that's not fully budgeting, but it's included. And so I'll cover that real quick. So we're looking at variances. So before I even start variances, I'll kind of just give an example. So let's say you plan to sell 10 units. This is your budget, by the way. You plan to sell 10 units for a price of $10 per unit. Therefore, your revenue should equal $100. However, you actually sell 20 units at a price of $6 per unit. So your revenue is $120. So as you can see, your revenue, you actually gained $20 more in revenue than you expected. So because we're looking at variances, that is what would be called the total variance. But if you're at an executive table and the CEO asks you, okay, how much did our revenue change based off of what we were expecting and what we actually got? And you said, oh, it went up $20. He'd be like, okay, great. Why? And so this is kind of where these variances come in handy. So first is the sales volume variance. Actually, before I even explain that, in simple terms, before we even use the mathematical equations, what you would probably say to explain why it went up by $20 is you could say, okay, it went up, we sold 10 more units than we thought we would, but we sold them for $4 less than we thought we would. So all in all, that equated to $20 more in revenue. But the sales variances just explain exactly how much the number of units and the price difference affected that overall revenue. So the first variance we're going to look at is sales volume variance. And that is the actual minus budgeted number of units multiplied times the budgeted price per unit. So in this case, the actual units were 20. So 20 minus the budgeted units were 10 equals 10 units multiplied by the budgeted price, which is 10. And that's saying that based off of an increased number of units, you're expecting to sell $100 more in revenue. Because that's positive, it means you're selling $100 more than you expected. So the sales price variance is actual units multiplied by actual minus budgeted price per unit. So if we want to take our actual units, our 20, multiplied by the actual minus budgeted price, so 6 minus 10 equals -4. That tells us that our sales price variance is -$80. This means that based off of the decrease in sales price, we're expecting to lose $80 in revenue than what we were initially budgeting. And as you can see here, the total variance is either found by taking the you can find by taking the actual revenue minus the budget revenue. So actual revenue is 120 minus 100 equals $20 in total variance. That's positive. Or you could take the sales volume variance plus the sales price variance. So this $100 plus this -$80 again equals an increase in $20. So the reason we do this is so that we can conceptually and mathematically explain why our revenue went up $20 over than what we were expecting. And so you're going to use this kind of format, this kind of language format. So all you're going to say is you're going to start with a sales volume variance. So you're going to say, okay, so we sold 10 units more than what we were expecting to sell, and at a price of $10 per unit, that should have increased our revenue by $100. However, now onto our sales volume variance, because we sold 4 units less than because we sold the units for $4 less than we thought we would have expected an $80 loss in revenue than what we were expecting. But because we expected to gain $100 from that volume variance, and we expected to lose $80 from the price variance, that means all in all, we increased our revenue from the budget revenue by $20. So again, our volume variance was an increase of $100. Our price variance was a decrease in $80. Therefore, our total variance ended up being a positive $20. So we made $20 more than we were expecting. That is the sole reason why you do sales volume variances, just so you can explain it out mathematically and conceptually. So now that we got that out of the way, we're officially done with all of the math you'll need in Mac. So why don't you go and try a practice problem with that and see how you handle it.